Hello traders, Mark here from Flipside Trading. It's December 14th and welcome to our weekly vlog. And this week we're going to discuss two things. Number one of our trades we did in SPX. We're going to talk about the analysis and how we decided to put it on, of course, then how we managed it. And secondarily, we're going to get to a little bit more on the brink section, which we introduced last week. Right? A lot of folks are interested in that, yes, we have a raging bull market, but all things come to an end and we don't want to be caught short. So it's kind of a monitoring system of the markets, and we'll talk about one of the key items that we're going to be monitoring in the future. So we have to take care of a little business first, as always, right? Your disclaimer, this is for educational purposes only. This is not a recommendation to buy or sell securities. Trading and investing carries an inherent level of risk and is not suitable for all folks. So please make sure that you consult with your financial advisor before taking any action. All right, so now let's take a look at the S&P 500. Right, we had an SPX, put vertical that we're putting on at 31.15. But what we're doing here, we're taking a look at the futures chart, and the reason we're doing that is because SPX itself does not have a volume profile, right? It's an index. It's not actually an entity itself. It's not an ETF like SPY. So therefore, there is no real trading volume on it, even though you can trade the index. So we're using as a proxy the S&P 500 futures. And so the first thing we want to take a look at when we look at a daily chart is we want to see whether, what trend are we in? Are we in an uptrend? Are we in a horizontal consolidation? Or are we in a downtrend? Well, you can see here that we definitely have higher highs and higher lows. So that puts us in the uptrend. Our ADMA is stacked on top of our 21, stacked top of our 50, stacked on our top of our 200. Our MACD right here, our basically momentum indicator, it's above 0, and we have a line cross, and our RSI is also above 50. So all these things suggest that we will have, we're in an uptrend, so this is just bullish. So let's take a look at a couple key things in a little more detail to talk about resistance and support. And you can see here if they're bullish, we look at support. So the first thing we need to account for is, look, right over the last couple of days, this yellow line is the ADMA. It's serving as a very definitive line of support. So that's one key area we want to take a look at. Now we also want to take a look at the value area. And the value area you can see is here between this red line and this green line. And what this value area represents is one standard deviation, or approximately 70% of the volume by price traded in the month of November. And we project that forward and say, okay, if this was the action in November, this then projects into December. And you can see here that at the top of the value area at 31.21, it serves as also a very good line of support. Matter of fact, it almost coincides and has a confluence here with the 21 EMA. So that's a very good piece for us to look at. And you can see here it dropped all the way down to the bottom at 30.72. And look, when we had our big pullback a couple of days ago, it hit right down here at the bottom of the value area itself. So you can see that these value areas provide another, should we say, informative way to measure support and resistance. And of course, the white line here is what's known as the point of control. This is where the peak volume occurred, and that also can serve as a point of resistance and support as well. All right, so we know that we're definitely, from the daily chart, we're looking to be bullish. We see that we have some support at least underneath the ADMA, but we want to take a deeper dive, right? We want to look at the hourly chart as well. And we want to look at the hourly chart because it gives us a little more granularity. And if the hourly and the daily align, then we have a lot of confluence and therefore more confidence, and we have an edge in order to place our trade. So let's take a look at that. Let's pop down here. Got a screen cap. So look at the hourly chart. Again, you can see what we have, right? Higher highs, right? Higher lows, higher highs, higher lows. So again, right, we're in the affirmation. We have that uptrend. You can see here that I brought over the ADMA, right, from the daily chart just to show you where it's at. And you can see we have those, we have these nice key points of support here as well. So it's suggesting that, hey, if we're below 31.39, that'd be great. We also have the value area for the week. And the value area for the week is right here. And you can see, and that, remember, this is the past week projecting forward. And you see that we have a key line right here at 31.59. So we have one line of support at 31.59. We have another at the 8 EMA. You can see that we have a third type, another line of support here at 31.30. Right, this is kind of a natural line of support, all the way across based on price action. And I brought over the 21 EMA from the daily chart, as well as that value area high. And now we have this confluence, this cluster right here of all this support. So now we have 1, 2, 3, and then a whole cluster, so 4 areas of support. And what we're able to do is find the different options, the 31.10, 31.15, selling them for about a quarter, and we're underneath, those levels. And you can see that we placed the trade kind of right about here that day, right? And obviously it went up and then it pulled all the way back down, but you know what? It pulled back down and hit our support. So overnight, it kind of went, back and forth. And the reason it did that, of course, is trade news, right? This is a headline-driven market at this point in time, and the Wall Street Journal is reporting that we did, in fact, have a trade deal with China. It just needed to be, kind of written down and ratified. But of course, our president didn't want to be upstaged by the Wall Street Journal and being leaked, so he said that there was no trade deal, and that's what happened right here. And you can see everything pulled back. And then, of course, once China came on and confirmed it, we bounced up and moved back up. But again, that key support area, held true. So even though we had a pullback, during that time, there was no reason to worry. We ended up finishing, 60 points away from our short strike at 31.15. And we were just in great shape, and we didn't even breach the first line of support. So there was no need to take any action, whether defending that trade by buying some puts or by closing that trade out in case your P&L went the wrong way. Ultimately, the trade expired worthless, right? We were able to go ahead and lock basically, 5% gain in 11 hours. So a great trade. Once again, take a look at your hourly and your daily chart. Look for points of confluence from the different support or resistance areas, depending which way you're looking at. Right, start with the trend, and then find that area underneath that gives you that 75-80% probability, and then you have a lot of confidence to play that trade. Excellent. So that's our trade for for the week, and what we want to do now is go ahead and move into our on the brink section here. And we want to talk about the risk in the bank and the repo markets. And this isn't getting a lot of play in the financial news. And it's obviously trade news has been the word of the day, but it's something that we definitely need to take a look at, because it's the scale is pretty potentially alarming. So let's take a look at this. So right now, the Fed, right, is having a repo bailout, and they're saying, no, this isn't QE. But they've injected over $278 billion, right, into the securities repurchase market since mid-September. Initially, it was just a one-time thing. It was called out as just kind of a confluence of tax payments, and therefore the banks ran out of liquidity from the reserves to pay that. But that wasn't the case. It was ongoing. And then just on December 10th, the Fed announced an additional financial injections, not only to the overnight repo market, but longer-term repos as well. We'll talk about repos and what they are in a second. And the key thing is, the bottom line is look, the Fed has injected over $500 billion in the past 6 months to support this financial system and supposedly this, great and humming economy. And when something like that happens, there's two ways to look at it. Number one, it's all right, the Fed is taking action. Hopefully they're ahead of it, and they won't lead to any type of structural collapse of the financial system. But at the same time, the Fed doesn't have that great of a track record. So it's something that we have to look at it, and we have to look at it from the problem is that it was not an isolated occurrence, right? Potentially there is a longer-term structural problem, right? Liquidity is probably much lower than the Fed initially believed, therefore they had to take action. The next thing is that banks and institutions probably have more leverage and debt accumulation out there than the Fed was initially led to believe. And we're going to take a look at one view of what that debt and what that risk may look like. And of course, that the banks, the way that the banking system works is that they're all interconnected, right? The top five produce about 95% of all the payments, responsible for all the reserves. And so if one goes down, then you have the fear of contagion. So the good thing is that the Fed is taking action. Now, the thing we want to look at is, is there a risk to us in kind of the near or long term? So let's go ahead and take a look at the repo market itself. So what is a repurchase agreement? So basically, there's a borrower, and this borrower possesses treasury securities. And what they do is they take these securities and they sell them, okay, for a specified time period, to a buyer. And the buyer obviously has cash, and they give them cash back. And there's a promise, right? That promise is that I'm going to buy them back at a certain date, and I'm going to buy them back at a higher price. And that higher price becomes a default interest on that loan, if you will, right? It's a collateralized loan is really a way to look at it at maturity. And if there's no one to lend, right, to buy these securities, then the government is the lender of last resort. And they step in. And obviously right now they're stepping in, right? They're the ones that are injecting this money, that are buying back, these securities. And the Fed is, very concerned about this because this is one of their main policy tools in order to manage and spur the economy, right? As you can imagine, if you have a low repo rate, then it's very cheap to sell your securities for a period of time and have cash in order to invest and or cover your operations. If they kick up that rate, right, then it's a disincentive to go ahead and sell those securities, because when you buy them back, you have to buy them back at a much higher price because you have a higher interest rate. So think of it really as kind of a loan portfolio type of a transaction, right? No need to get into the dirty details, but just know that the Fed now is lending money to the banks. And let's talk about why. Let's take a deeper dive into what the potential structural weakness could be. So, number one is when banks don't lend to each other, they kind of know because they're holding each other's paper, and we'll quantify that in a moment. And it's like, hey, I'm not going to lend to Chase, or I'm not going to lend to JP Morgan because, hey, these guys, I don't know if they can pay back the loan, right? This is part of what every single lender does. They assess the credit risk, and if they feel that the person that's selling them the securities can't buy them back, then that's not a good loan, and they want more risk premium, and so therefore a higher interest rate. So that's why the Fed is intervening in order to keep that interest rate low. The next thing is that bank reserves are less than normally expected, especially to cover year-end balance. So when we talk about year-end balancing, what happens is not only do the banks themselves have their own accounts to kind of balance up and close, but we also have a foreign intervention, and that foreign intervention is really foreign exchange, because remember that the U.S. dollar is the underlying world currency, and so when they have to purchase goods or close contracts, they have to take euros or yen, and they need dollars, and therefore these banks are the ones that usually provide that liquidity as far as that foreign exchange in order to make that happen. But the banks, as usual, are always trying to maximize their dollars, rightly or wrongly. Let's not get into the blame game here. But what's happening is that they have funds in their retail checking accounts, and they shift those overnight into savings accounts, which are exempt from reserves requirements. Remember, after the 2007 financial crisis, Dodd-Frank came out, they're required to hold a certain amount of reserves. Well, those reserves were based upon the retail checking accounts. Well, if you make the retail checking accounts smaller, i.e. by sweeping those dollars into savings accounts, then they don't have to have as much money on reserve. And if you don't have much money on reserve, well, then potentially they can't meet these year-end requirements that we just talked about. So what they do, of course, is they apply these to their operational pieces and other business pursuits, right? And that derivatives, right? Especially over-the-counter derivatives. If you remember, derivatives are one of the key things that got us in problem, in 2007, right? You remember the CDOs and the CDLs, okay? Those are the things that we might be a little bit concerned about. And what the key thing is that these over-the-counter derivatives are not cleared by a central clearinghouse, okay? And therefore, they're a private contract, and they're a little bit sketchy on who has what and who's holding who and who's holding what paper. And because it's a clearinghouse, there's no real guarantee that these debts will be repaid because it may be with a non-creditworthy financial institution. So if you remember, right, no one would lend Lehman Brothers any money, and that's why they collapsed, because everyone knew that they were, their risk debt quotient ratio, far exceeded anything they wanted to take. And then we found out, of course, that we had all these OTC derivatives and CDOs with AIG, which was something that they couldn't handle, and that brought the whole collapse down. So that's the thing we want to monitor. So let's take a look at this a little bit more and kind of quantify some things. So like I said before, we take a look at the risk dimension, and you can see that the top 5 banks here are responsible for the majority of all payments. I mean, JP Morgan itself, this was like twice. Bank of Mellon also is up there. Citigroup, Bank of America, Wells Fargo, right? All the big ones. So if these guys go down, then there's risk to our financial structure. And if you look at our intra-financial system liabilities, i.e., this is what we get back to before, who's holding whose paper. And you can see that JP Morgan is holding, a lot of paper from a lot of different folks, right? They're swapping these papers back and forth. And so if one of them goes down, then the other won't be able to pay them, and vice versa, right? Because it's you just can't balance that seesaw. And let's take a look at over-the-counter derivatives. Again, you can see that we're in the trillions of dollars, right? 40, 50, trillion dollars. And the key thing about that, if we look down here, you can see that the total assets of JP Morgan, right, is basically 2.7 trillion. But their overall derivatives, the notional value, is $55 trillion. Now, obviously, right, they have some futures and options which are done by a clearinghouse, and those things are, pretty good shape. But this over-the-counter stuff is big. So what this means is that the banks have kind of, moved into their, tried and true mechanisms in order to earn money. Some of those are very risky. A lot of people will tell you, the notional value between, the debits and the credits add up, and it's really not that much. But again, if you go back and look at who's holding the intra-financial system liabilities, that's not the case, right? If one goes down, they all go down. And I think that's why the Fed is concerned, and based on the concern, they're injecting those dollars. So does this mean that we panic? Does this mean that we, go crazy? We pull our money out of the market? Well, let's take a look at that, right? Because number one, we know we're in a great bull market. Number two, the Fed is taking action, so maybe it's something we monitor. So let's take a deeper dive and look at some of the technicals of the market itself. Oh, let me go back here. So let's go back to the financial crisis in October 2007. Right here, this green line. Let me get my little drawing tool set for you. This green line is the 200-day moving average, right? This is the 50-day moving average. This is the 21-day moving average. And you can see that we're stacked inverse, right? We're stacked to the bearish standpoint. Price is underneath the 200, and gradually it slips down and comes underneath all the moving averages. So the moving averages are stacked bearishly, and we're dropping, right? Here's right, we have this big cutoff, right through here, and that really, put us in dire straits. All right, so that's the price action. Now let's take a look at our momentum indicator, right? Our momentum indicator at that point in time, when things are getting ready to drop, is right here, and it's kind of, below zero, right? It's below that horizontal line. And then you can see that this blue line is below the white one, right? That tells you that the indicator line itself is moving lower, right? Every time it's below that, that is not a good sign. And sure enough, we had that increase, and we took that deep dive in momentum. And then lastly, on balance volume, right? We're kind of hanging. This is this yellow line is the 50 moving average of that. And once we crossed that 50 moving average, then Katie barred the door. We were going. So let's take a look at another time period. And let's see if I could pull this up for you. I think I got to get it off the screen to go. Okay, so if you remember, right, last October we had a really healthy pullback, and look at the similarities, right? Again, the green line's at 200, so price started coming underneath the 200. We have a crossing of the 50 under 200. Then we have the 21. And so again, we start moving in this area right here. We have this bearish stack. Right? Stack of moving averages, price underneath that, suggesting that we're in a very bearish, precarious position. Again, look at our momentum. Look at MACD. It's underneath zero, and then the blue line crosses underneath, and then Katie barred the door. And then lastly, look at our on-bounce volume, right? It's below the 50 moving average. It stayed below, and it kept moving below. So now you can see that the market provides us certain signals when it is in a bearish mode or pretending bearish. So we need then to look at what does that look like today. And if we take a look at that today, right, you have to say to yourself, does this October of 2019 right here, does that look anything like October 2018 or October 2007? And the answer is absolutely not, right? At this point in time, right, the 200 is underneath. We got a nice bullish stack. Here's the 50. Here's the 21. Here's the 8. Price is moving up. We got higher highs, higher lows, right? Nothing like it is here, right, where it's totally inverse. The stack is reversed here. Look at our momentum. We crossed zero way back here, right? In basically early October. We're moving up, and matter of fact, we're starting to cross again right here. And look at our on-bounce volume. Again, completely the mirror image. So what does this mean for us? It means, look, we probably don't want to be adding a lot to our positions at this point in time, but it doesn't mean get out of the market. This market definitely has potential, and I'll show you one more slide of what that potential may be. But until we start seeing, characteristics like October 2007, October 2018, right? There is not a broad technical indication that the markets are having a structural problem. And we've taken a look at it. Is what the Fed's doing, is that helping? Is that going to solve the problem proactively? Don't know. What we want to do, we want to monitor the situation such that if we do see a change in sentiment and a change in character, and we do start seeing this kind of inverse rollover, well, then we know to start taking defensive actions. But at this point in time, it doesn't seem to be a reasonable thing to do. So let me pop out here, and I want to get to one more slide real quick. And I want to go back to, okay. So the other key thing to talk about, right, when we talk about having these pullback or recession, everyone was saying, oh, the world is everywhere else in the world is falling down, and the U.S. market is propping us up, and everyone's coming to the U.S. market for yield, and that's true. Okay, from the overall historical standpoint, you can get a feeling for that, but really, if you do some analysis, and this is kind of one of my proprietary charts, is that the rest of the world kind of more or less acts as a catalyst. In the standpoint of, if it's doing bad, then everyone will run to the U.S. market until it gets too bad. Then, right, there's a tipping point, and it serves as an anchor, and it'll pull us down. So what we have here on this chart, and this blue line represents the rest of the world, stock markets. And you can see that every time it crosses the 13 EMA, okay, and if it crosses down, and the SPX is crossing down, then it's gonna be kind of an accelerator, if you will. It's going to be a catalyst, okay, to bring us down. Conversely, it brings us up as well, right? If the rest of the world, right, we see them crossing this 13 EMA as it starts to move up, and we go ahead and we cross the 13 EMA down here, boom, big acceleration, right? We just talked about, let me show you the screen draw here. Let me get to, we just talked about, right, last October, right? This is what happened last October. The rest of the world dropped down, crossed the 13 EMA. We held on for a little while, right? You can see where we held on, then boom, we dropped all the way down until January, and then we had that huge reversal. And then we had that reversal, and it kind of moved forward. And look where we are today, right? We've recrossed from the rest of the world. We're moving up, and it's serving as kind of that catalyst to help us up for a while. So given those pieces, unless there's a catastrophic event, the market does not appear to be able to reverse, right away. Usually what happens, as you saw on the other charts, and a top is more of a process. So at this point in time, again, it's something that we monitor versus, running from one end of the ship from port to starboard and pulling all our money out, right? This is what on the brink is going to bring us. This is what it's going to help us to do to monitor these situations when we look at these potential, structural risk in our financial system, and then will help us, make informed decisions on how we want to manage our money. Okay, gang. Hey, thanks a lot. It's been a great time spending with you. I had a great time skiing today. It was awesome. First day out. Had about 8 inches of new powder. So just going to relax for the rest of the evening. So you guys have a great week, and we'll talk to you and catch you on the flip side. Thank you.